Hello, welcome to FastPass University, the only place where you can learn your insurance exam content free, state by state. No paywalls, no giant courses you're forced to buy, just clear lessons that help you pass fast. Please make sure to subscribe so you don't miss any of our new videos that we are dropping every single week. And if you haven't done so already, you can go to our website, fastpassinsurance.com, and grab the workbook that goes along with this video. Every video we put out there, there's a workbook to go along with it. So let's jump in. We are going to be going over life insurance basics today. If you haven't watched General Insurance yet, that's kind of like the first chapter in insurance, right? Even though not all states test exactly on general insurance, that is the building blocks, the foundation. Life insurance basics would be what I would call chapter 2. Okay. But this is the basics, the building blocks, the foundation of life insurance when it comes to the insurance game. We're going to be going over insurable interest and uses of insurance, policy classifications, all of that fun stuff. So, depending on what state you're in, this can be a large portion of your exam. Either way, like I said, building blocks, the foundation of everything else we're going to learn on life insurance. So, all right, insurable interest. What is insurable interest? Insurable interest is a legitimate financial interest in the continued life of the insured person. The policy owner must suffer a financial loss if the insured died. Okay, so insurable interest, you have to have some type of relationship or interest with the persons or things that you want to insure. In property and casualty, you have to have an insurable interest, right? You can't go insure a car that you don't own. But in life insurance, right, you can insure lives that are not your own. But it can't just be anybody's, right? Imagine if people could just go around and buy life insurance policies on strangers. That would be creepy, right? Because they're sitting there waiting for that person to die in order to get their death benefit. So in life insurance, they usually say blood and or business. You need to have either a blood or business connection, interest, right? You have to prove that you would suffer some type of financial loss if the insured were to die, okay? So a spouse always has insurable interest, but a business partner may also. If you guys are co-owners in a business, and we're going to go into some examples of what life insurance looks like in business. Creditors, right? They've got an interest in the money that you owe them, and employers, especially when it comes to like key employees, things like that. So insurable interest, you must have it in order to get a life insurance policy. You obviously have interest on your own life, and then spouse, kids, loved ones, but generally it has to be some type of, or you would be impacted, not just emotionally, right? So maybe not like your great uncle that you haven't talked to in 30 years that is not a part of your life, right? Another important question they love to ask is, when must insurable interest exist in life insurance? Only at the time of inception or policy purchase of policy purchase, policy inception, when the policy is put into place. Okay. We're going to dive into a little bit more on that, but just wanted to say that while we're here talking about insurable interest. Practice question. Sarah wants to purchase life insurance policy on her business partner, Tom. When must Sarah have an insurable interest in Tom's life? Well, I did not realize that this was the practice question right here. So glad we just went over that. A, only at Tom's death. B, only when the policy is issued. C, both at the issue and at death. Or D, whenever premiums are paid. The answer is B, insurable interest must exist at the time of the policy issue. There are certain states, just a couple, that the second a divorce goes through, that life insurance, the person's no longer can be listed as a beneficiary, but you'll learn about that in your state laws and regulations. But for the majority of the states, um, the answer to this question, it's still going to be the answer to this question is when must insurable interest exist? And it is at policy purchase at the time the policy was put in place. Um, but in the majority of the states, if you bought a policy on somebody or you're listed as a beneficiary, as long as that existed at the time of the policy being purchased, that can remain in place as long as the policy is still being paid on. And actually, you don't have to have insurable interest with the beneficiary, right? You could put anybody and anything as the beneficiary. Get into that into the life insurance policies, but if you own the policies, if you're going to go buy the policy in somebody else's life. So in this situation, Sarah wants to purchase life insurance on her business partner because she's going to be the owner of the policy. So must only exist at the time of the policy purchase. In property and casualty, in case you came from that world, that's the only reason why I reference it a couple times. It's the opposite, right? Insurable interest must exist at the time of the loss. So we are going to stick to life insurance, don't worry. But there are those couple key, opposites, things like that I want to point out. Okay, so as we were just saying, when must insurable interest exist? At the time of policy issue, not at the time of death. This is the opposite for property insurance. So, kind of steps, the application, the insurable interest is required in order to buy a policy on somebody else's life. Policy, if it's issued, as long as it is paid, things like that. When the time of the claim or death, they do not need to prove that you still had insurable interest. Test scenario. John purchased a $500,000 policy on his wife 10 years ago. They divorced 2 years ago, but John continued paying premiums. His ex-wife dies. Can John collect the death benefit? Yes. Yes, unless you're in those couple states, but you'll learn about that in regulations. So, but yes, for 98% of you, yes, yes, yes. Insurable interest only needs to exist at the time of application, at the time of issue, not at the time of death. The policy remains valid even though the insurable interest no longer exists. Okay, so majority of the time when we're thinking about life insurance, we are thinking of it from a personal use stance, right? There are business policies, creditor policies, like we just said. Majority of policies that, not, I wouldn't say the majority of the policies that are written are for personal use. It's actually probably the opposite, but because of businesses, they've got the funds and things like that. But that's generally what you think of for life insurance, right? And so why do people buy life insurance? What is the use of it? Obviously, the main one, survivor protection. It replaces lost income to support dependents after the insured's death. Most common personal use, okay? Right, so that, you know, if you were bringing home a certain amount of salary each year, or you were paying the mortgage, things like that, this helps keep your survivors, your dependents, able to maintain the life that they had. Estate creation. It creates an instant wealth for beneficiaries. Death benefit provides immediate estate value regardless of premiums paid. If I were to pass away today, the amount of money that I would be leaving my children if it came to just, assets or money in my bank accounts, things like that, it would not be substantial enough if I didn't have life insurance. They wouldn't be able to um, do much of anything, right? But because I do have life insurance in place, I have policies in place that will pay off the mortgage so my husband doesn't need to worry about that. Put my kids through college, all kinds of things. So my estate without life insurance is small, right? I've got some equity in the house. I've got so much in savings, etc. But my life insurance policy creates an immediate estate for my family. Another use of life insurance is cash accumulation. Permanent life insurance policies build cash value, tax deferred, and they often provide living benefits where people can take out loans and withdrawals and essentially kind of become their own bank. There are some really neat things that can be done with life insurance with cash accumulating policies. And then liquidity. It provides immediate cash to pay final expenses, debts, and taxes without selling assets at unfavorable prices. So it's an instant cash payout to pay off the mortgage, or there's final expense policies that are in place just to pay for your funeral or cremation, things like that. I mean, how often are you guys seeing on social media somebody's passed away and they put up a GoFundMe to help being able to pay for those expenses? So um, there are certain final expense policies in place for that. Also, if you have larger policies, obviously it can be used for that as well. So it is instant liquidity. So they could ask you all of the following are personal uses of life insurance, except, and then throw something that's not on this list, or the things that we go over for personal uses, to just make sure that you are aware of those. A couple other personal uses of life insurance is estate conservation. Proceeds pay estate taxes and settlement costs, preserving assets for heirs. It prevents forced sales of property or business interests. So there are certain ways to protect from the taxes and settlement costs and things like that when passing your estate and assets on to your heirs, um, especially for very, very large policies. For the wealthy, it creates an estate conservation. Two other uses of life insurance policies for personal uses are viatical settlements and life settlements. You must check with your state if these are allowed, because some states do not. Um, but they are two different ways where you can kind of cash out your life policy while still alive. A viatical settlement is if somebody is terminally ill, the insured sells their policy to a third party for a percentage of face value. Typically requires life expectancy of 24 months of less. So if you are terminally ill and expected to pass away within the next 2 years, there are certain policies or certain viatical settlement brokers that will purchase the life insurance policy usually at a smaller face value. So let's say that somebody had $100,000 policy, but they've just found out they've got 8 months to live. They may cash it out for $70,000 so that they can take care of some things before they pass away, or maybe get into some trial study, pay medical bills, things like that. And then life settlements are a sale of a policy by an insured who is not terminally ill. It's usually seniors, and they receive more than cash value but less than death benefit. So you don't have to be terminally ill for a life settlement. There's going to be a lot of regulations and rules in place because, again, you're selling your policy to somebody who is not going to get paid until you die. That's kind of creepy, right? Meaning you don't want to just like go sell it off to some stranger in an alley, right? Because they're just sitting around waiting for you to die to cash these out. So they're highly regulated. Some states they're not even allowed. So, but you do need to know what they are for the exam. So just know for the difference, viatical must be ill, must be terminally ill, right? But life settlements, you do not need to be. All right, so how do you determine the amount of life insurance, right? A lot of the times it's going to be cost, okay? That's going to be like the number one deciding factor when you are selling life insurance policy is what is within somebody's budget. But how do they determine how much life insurance somebody should get? How much life insurance does somebody need? And there are two different ways that is calculated. One of them is the human life value approach, and the other is the needs approach. Okay. Human life value approach calculates the present value of future income and that the insured would have earned based on current income, work life expectancy, discount rate, inflation assumptions. It doesn't account for specific family needs or debts. So when we talk about needs approach here in a second, you'll see what I mean. But what this is doing is just literally taking how much would this person make in their life, right? If they were to live a normal, long, healthy life through, the normal age that they would probably have retired based on the income that they make right now, and, considering things like inflation, etc. They're going to say, let's say this person makes $100,000 a year. They're expected to work for another 22 years before they retire, and then calculate inflation, things like that. And almost every company that you work for, when you go on to quote, it's going to help you. It's going to have some type of place where you can plug these numbers in, and it's going to do that calculation for you. And they may say, okay, so and so, you need $2.5 million in life insurance, right? Now, obviously, it's going to be if that person can afford it, they may just get what they can or what they can't. You'll worry about that when you're actually on the selling side of things. But before the exam, you need to know what the human life value approach is. It is how much is this human life valued at, which sounds awful, but how much money will this person make in their life if they make it to the life expectancy that they should. Needs approach is more often used. It is also a more practical method. This is going to calculate specific financial obligations. So not just how much you make, but what would you actually need? How much is your final expenses going to be? Your funeral, medical bills, cremation, things like that. What debts would you have to pay off? Do you have any mortgage or loan balances? On top of the income needs, education funding for your children to go to college, emergency funds for your spouse. So this is usually going to be calculated much higher. It's more often used. Again, once you're out there selling the real policies, even though these numbers come up, very high sometimes, it's going to be what the person is looking for, what they can afford. But this is how you kind of calculate how much life insurance somebody should need. And actually, if you go online, there are some free, just type in life insurance calculator or life insurance needs calculator. And it'll be a little, it's almost scary. The number's always really high, higher than you think. So, all right, quick check. Which approach considers the family's ongoing financial obligations and debts? Human life or needs approach? Needs. Just think about it. They're paying attention to what the family needs. Not just how much you made or would have made, but what else are the needs? So that's going to be the needs approach. The needs approach focuses on specific financial needs and obligations, while human life value focuses on income replacement. Common exam trap. Watch out, the needs approach is considered more practical and comprehensive than the human life value approach. Questions often ask which method is better or more commonly used. So human life value is income-focused theoretical calculation. The needs approach, it is preferred, it is more practical, it's going to address specific financial obligations. It's going to be the better one, right? Quote unquote better. Right? Everybody's going to have different needs, but another common trap question A, a business wants to insure its top salesperson for $1 million. Which approach should they use? Human life value sounds business-like. Wrong answer. The correct answer for key person insurance is that they use the needs approach based on financial loss the business would suffer, not the employee's personal income value. So I know we haven't talked about business uses of life insurance yet, and we will, but what that person brings home each year is not their value to the company, right? Usually, you're making a salary, you're worth much more to the company, especially when you're a key person. But we'll get into that. So, almost always, the answer is going to be needs approach unless they're asking you the definition of the human life value approach. Okay. Okay. So, moving into business uses of life insurance. Um, Buy sell funding, key person, executive bonus plans. There are a couple different business uses of life insurance. Um, we'll go over those. Buy sell funding is kind of the trickier of the three. So I'm going to give you some examples on that. Okay, so buy sell fundings are funds purchase of deceased owner's business interest. It is a life insurance policy that is put in place to buy out the deceased owner's business interest. Okay. Each owner owns a policy on other partners. Each owner pays their own premium. And the benefit goes to the surviving owners to buy out the deceased share. So, true story, myself, Randy, and my brother, Jonathan, went into business together. We bought an insurance agency back in 2012 together. So over here, we're going to show my husband. So my husband and my brother's wife. Okay. So Jonathan and I own the business together. If something happened to one of us, our interest in the business, our 50% ownership, immediately goes to our family, our survivors, right? So if something happened to me, my husband would be 50% owner of the business. My husband is a painter, right? Sitting in front of a computer all day would drive him nuts. He likes to paint houses alone with his headphones on, listening to podcasts, right? My brother's wife is an elementary school teacher. She gets so bored when my brother and I talk about insurance, right? They do not have insurance backgrounds. They do not have any interest in doing what we do, right? But they have interest in our ownership in it. They have interest in the, our money, our estate, right? So if we did not have a buy sell agreement in place and something happened to me, my husband would own my half of the business. Okay. Which is, you know, challenging for my brother. Because what if my husband was like, I don't want anything to do with an insurance, just buy me out. Let's say that the business was worth $500,000 at that point. If my brother had to, businesses don't usually have that type of cash on hand. If he had to buy my husband out for $250,000, it could make the business crumble. Okay. Or if my husband was like, well, I need to go work in insurance to try to keep my wife's, part of the business going, he'd be miserable. My brother would be miserable. He probably wouldn't be doing anybody a service. It would just suck, right? So, same thing. If something had happened to my brother, my sister-in-law, she loves teaching. She was educator of the year this year. She doesn't want to work in insurance, right? But if that's what she had to do to keep her family surviving, she would, be trying it. Or I would be trying to make sure that she got, Jonathan's half of the business. And again, now I'm losing the business. So, um, now imagine that there was multiple people involved. Like, let's pretend it's me, my brother, and I don't really have two brothers, but my brother is a best friend, so we'll say Michael. um, and he's married too. What if there was multiple of us? Steven and Jessica. These people don't exist, right? But um, we all had part of it, right? It's going to be hard if one of us passes away or something happens. There are disability buy sells for same kind of thing. So if somebody were to become disabled and no longer able to work there rather than a death. So I'm going to go back to how this works with my brother and I. Oops. So Jonathan and I, we bought this agency together, and then we did buy a buy-sell agreement. What it is I buy a policy on Jonathan, and Jonathan buys a policy on me. And remember, we were fake evaluating this agency at $500,000. So my half would be $250,000 on Jonathan. Jonathan buys a $250,000 policy on me. He's the owner of the policy on me. He owns this $250,000 policy on me so that if anything were to happen to me, it seems so morbid, it's just like drawing an X over me. He can use my life insurance policy and give it to my husband and keep the business going. Same thing. I have a policy on him so that if something happens, I use that life insurance money to pay out to his wife. Okay. So they do need to be put in place by a lawyer. Actually, they call it an attorney in fact. They say which policy must an attorney in fact put in place, who owns the policy, who does the benefit go to, things like that. So one more example. They could ask you how many policies need to be in place if there was a company owned by 3 people. So we're going back to this scenario with me, Jonathan, and Michael. Okay. So I would need to buy a policy on Jonathan, and I would need to buy a policy on Michael. Michael would need to buy a policy on Jonathan. Michael would need to buy a policy on me. Jonathan would need to buy a policy on Michael. Jonathan would need to buy a policy on me. That is 6 policies. It is 2 policies per owner. So if they said there were 55 owners of this company and they all were buying buy-sell policies, how many buy-sell policies would there be? 110. Okay, so it's to purchase the deceased's business interest so that they can pay it to the survivors of the deceased business owner and buy out their portion of the business. Key person insurance is similar, except for it's not business partners. It could be just like that one main key employee, like a dentist. Okay, so let's say there's this dentist office, only that dentist has, that specialty. He's been doing it for this and this amount of years. If something happened to him, key person insurance, the money is going to be paid to the business. The business owns the policy. The business pays the premium. It's not tax deductible though. And then the benefit is paid to the business tax free. That's why it's not tax deductible. You'll learn about that once you get into the taxes of life insurance. We'll be having a video up on that soon. But so this is so that they can go hire a new key person. Maybe it's something more specialized. I'm not saying dentists aren't specialized, but maybe it's somebody, like a really niche specialized thing, and it's going to take time, and this person's going to need to train. You would have this policy in place to keep the business running while they replace that key person. They also, life insurance can also be used as an executive bonus plan. The purpose is for employee retention and reward. The employee owns the policy, but the employer pays as a bonus. It is tax deductible to the employer because they're not the ones receiving the death benefit, right? Because the benefit goes to the employee's beneficiary. So make flashcards on these, get familiar with who's paying what. You do need to know kind of the tax parts, but you'll learn about that in taxes later, so don't stress on that too much right now. I just wanted to mention it as we're talking about it so that when you're learning about taxes later, you're like, oh yeah, that makes sense. Um, but I would know who pays what, who owns what, where the death benefit goes to. With the buy sell, you need to know that there is an attorney in fact and that it is 2 policies per business owner. All right. So, buy sell agreement, legally binding contract between business partners that dictates how a deceased or departing partner's share will be reapportioned. It ensures business continuity and provides a fair price for the departing owner's interest, often funded by life insurance. You'll see that a lot. Which type of life policy is used in business for business continuity? It's going to be a buy sell agreement. Okay. Same thing. Partner A and B each owns a policy on the other. If the partner dies, the policy pays the benefit to partner B so that it can go to their estate. Partner B owns the business, estate receives the compensation. And I am realizing now I should have just went to this slide instead of drawing my little circles. But in this scenario, if partner A dies, the insurance policy on A, which is owned by B, pays a tax-free death benefit to partner B. Partner B then uses these funds to buy partners A's share of the business from partner A's estate. If you can see now why an attorney in fact needs to be kind of monitoring and managing these, because that person could just take that money and not give it to that person's estate. But that's what has to be done. That's what's put in place. So it ensures the business continues smoothly, business continuity, and the deceased partner's family receives financial compensation. All right, we're going to go into different classes of life insurance policies. We're not going to deep dive too much into life insurance policies. There's a separate video for just life insurance policies, so you'll want to check that one out. I will link it in the comments, but we're going to go over kind of the classes of life insurance policies here. Okay, so group versus individual. Group insurance, all right? We see group insurance usually at work, right? It's usually an employee-employer relationship, but you can also see them in like fraternal organizations, things like that, certain membership groups. And remember that group insurance must not be formed solely to get insurance. Must be formed for a reason other than to get insurance. Okay, there's a lot of benefits to having a group policy. It is cheaper. There's usually no underwriting. You could be, terminally ill and or have cancer or be, denied policies anywhere else. In a group policy, you can get it. And then it's usually cheaper because it's getting bought for a ton of people, right? So you can't just get together with 20 of your friends and be like, let's go form this group and get group life insurance. No, you must qualify as a group. That number of how many employees a place must have is going to vary by state. Check those out in your regulation videos. But just want to remember that highly tested question. You must, in order to have the benefits of a group life insurance policy or health insurance policy, the group must not have been formed solely for the purpose to get group insurance. Okay. So that is a huge test question there. The other test question that they love here is this master policy and certificates of insurance. Okay. So who owns the master policy in the group setting? When it comes to a group policy, group insurance, the master policy is owned by the employer or the organization. So they're going to have that huge documents, 1,000-page document. I worked for a very, very large car dealership that actually had multiple locations. and their property and casualty insurance policy book was like, not even kidding, like 15 inches in height of papers. And then they also had a second one that was like a foot tall in paper in this crazy binder for their life and health policies. That's the master policy, right? They're not sending that out to everybody. What they do instead is give everybody certificates to its members. And you know what those are? Your insurance card, right? You're going to get some paperwork too about what's covered in your policy and things like that. But the master policy goes to the employer or the organization, and the certificates goes to its members. Okay, write that down, put it on a flashcard, circle it, highlight it. They like to ask that question. Sometimes you'll get that question 2 or 3 times, just worded a little differently on your exam. So make sure you're comfortable with that. There is a lower cost per person. As I said, it is cheaper, right? When they're writing this many people, it's going to be cheaper to write it. And then there are no individual underwriting for large groups. Okay. They are also portable and convertible. So even if you were fired, terminated, or quit, you usually have the option to roll over or convert, not roll over, convert your life insurance policy into an individual policy. Okay. So there's a lot of benefits to that group insurance. Another reason why, can't be the only reason you got together as this group. Individual insurance. So if you go out and buy your own policy, your own life insurance policy, health insurance policy, things like that, the policy is issued to one person. Individual underwriting is generally required depending on what policy you get, what company you work for, right? There's so many different life insurance policies out there. Premiums are based on individual risk. It's more customizable in coverage. Usually they're guaranteed renewable, but they're going to be pricier. Practice question. An employer provides life insurance to all full-time employees. Each member receives a certificate. What type of insurance is this? It is group insurance. All right. Better question. An employer provides life insurance to all full-time employees. Each employee receives a certificate. What does the employer receive? Master policy. All right. Answer B, group insurance issues a master policy to the employer with the certificates to the individual members. All right, contributory versus non-contributory. Okay. This is how many people must participate based on how much the employer is contributing. So, group life insurance policies are characterized by who pays the premiums. Understanding the distinction is key for both employers and employees, and it is a frequently tested concept. Contributory plans. It means that the employees pay a portion of the premiums, with the employer covering the rest. So when they're talking about contributory versus non-contributory, they're saying who has to, no, that's not right. Let me word that differently. They're asking, is the employee responsible for contributing? Simpler, does the employee have to pay anything? If they do, if, there's some places that cover 100%, fully covers your medical plans, your life insurance policies, all your benefits, right? More likely than not, though, the employee is participating. They are contributing to part of the premium, right? It's generally a lot cheaper and they're usually not covering, paying the whole thing. But when they are saying contributory versus non-contributory, what they mean, who are they thinking about as contributing is the employee, okay? I used to get these confused when I was studying this 15 years ago. The who is contributing, they're worried about the employee. If the employee has to pay any amount, any portion of the premium, it is contributory. They are required to contribute to their policy premium. If it is 0% cost to the employee, they are contributing nothing. That is non-contributory. Their employer is not asking them to contribute anything towards their policy premiums. Okay, so you need to understand what the two terms mean, right? Which falls into what. And then you need to remember these two numbers. If the company is requiring that you pay part of your portion for your group policy, then that means that it needs to require a minimum of 75% of eligible employees to participate, right? So they have to offer it to everybody, right? That's the other thing about group policies, whether it's group health insurance, group life insurance, has to be offered to everyone, no matter which one it is, okay? Whether you are the janitor or the CEO, you have to be offered the same plan. But if it is a contributory plan, if they are making the employees participate in the payment of it, 75% of the employees must be enrolled. And you're like, well, how can we make that happen? It has to be, the policy has to make sense financially. It has to benefit them enough. It has to be a good enough benefit that at least 75% of the people in your company want to participate. You can't just go offer these outrageous policies and be like, you have to pay for all of it, and then be like, nope, nobody signed up for it. If you're offering this and you're requiring it, it better be a good enough policy with the premiums that make enough sense that at least 75% of the people, the eligible employees, now when I say it needs to be offered to everyone, it means, everybody that is, a full-time employee. They can put some limits like, 90 days or a year, whatever. But eligible employees must be offered to 100% of them. At least 75% must enroll in order for the plan to stay in place. The purpose of this percentage, this high participation rate, helps to prevent an adverse selection where only high risk individuals might enroll, right? Like if you've got, stage 4 cancer and you're going to get this job just to get this life insurance policy so that it'll pay out to your family, things like that, that would be adverse selection, right? We went over that in general insurance. That would be only, they're the only ones that are crazy enough to pay this high premium, right? It has to be a good mix. That's another reason for it, is that 75% of eligible employees must participate. It has to be a good mix of, different ages or health backgrounds, things like that. Employees usually have a specific enrollment window to join without providing evidence of insurability. Um, you know, they maybe have to wait until the open enrollment time, or they may have, so many days as they become eligible. That's going to just depend on your company. So contributory, who is contributing? The employee. And what is the number you need to know? 75%. If it is a non-contributory plan, the company is saying we will pay 100% of the premiums, then 100% of people better be enrolled, right? You can't do that. You cannot pay all the premiums and only give it to your favorite people at the business, right? From janitor to CEO, same policies, okay? Purpose of this percentage is, since the employer covers all costs, there is no concern about adverse selection, ensuring universal coverage for the group, provides widespread coverage for the group, and is simpler to administer. So for non-contributory, it is the employer is paying for everything, and 100% of people better be enrolled. All right, here is a summary table if you want to pause, screenshot, things like that. Also, again, if you haven't grabbed the workbook yet, you can do that on our website, fastpassinsurance.com. I'll also link that in the description. Just so that you are comfortable with this table or however you want to write it, or some key exam tips, C for contributory equals cost sharing, N for non-contributory for no cost to employee, whatever it takes for you to memorize this. You could see a couple questions on this section. All right. Ordinary versus industrial life. Ordinary life are standard policies with monthly, quarterly, or annual premiums paid by mail or automatic payment. Um, Industrial home service are small face amounts under $2,000. Agent collects premiums weekly or monthly at policy's home. This is rare today. We do not see this very often, but the exam still likes to test on it a bit. Industrial life is a largely obsolete, but still appears on exams as a historical concept, so make sure you're comfortable with that. All right, permanent versus term insurance. Again, not going to dive super deep into different types of insurance policies, but we're going to go over them for what you need for this chapter section, which is the life insurance basics. Check out our other videos to deep dive into insurance policies. But all right, permanent versus term insurance. Permanent insurance, that is forever. It is permanent. When you see the word term, think of temporary. Okay. Permanent insurance, it covers for the entire life. It builds cash value. Level premiums. There are multiple types of permanent insurance: whole life, universal life, variable life. More expensive initially. Okay. It can work out to be very beneficial, especially with, cash values, things like that, how long the policy's in place. Term coverage, temporary. It's usually for specified period, right? 10 years, 20 years, 30 years, no cash value, lower initial cost, purely death protection, but it may be convertible or renewable. When I was studying for this, my brother was already licensed. I told you we did go into business together. We no longer own that insurance agency. We sold it a while back, but I was like, well, why wouldn't everybody just get whole life? Like, why wouldn't everybody get permanent insurance or universal life? Like, it's got cash value and, variable. And he was like, obviously, but it didn't click to me right away. This one is going to be the cheapest option. Right? It's a lot cheaper. The policy's in place for 10 years. Insurance companies hoping that you don't die within that 10 years, 20 years, things like that. You paid into this policy, no cash value. The day you die or the day that the policy ends, it's over. Okay. You can usually convert it or renew it, but it's cheapest, it's temporary. And a couple questions they could like to ask, which type of life insurance policy is the most cost affordable or has the lowest initial cost? Term insurance. Which type of policy provides coverage for only a specific period? Term insurance. Which type of policy is considered pure death protection? Term insurance. Okay. And what that means is, like I said, so you buy the policy here, let's say you're 35 and you buy a 20-year term till age 55. If you pass away in the middle, it's going to pay out your death benefit. Okay? But that's purely death protection. Okay? If you die at 56, there is no death benefit being paid out. Test scenario: Maria, age 35, needs coverage for 20 years while her children are growing up. She has a limited budget. After 20 years, she won't need the coverage. What should she consider? Answer: term insurance. It provides temporary coverage at a lower cost, perfect for temporary needs like child rearing years. Okay. Also, cost is really going to come into place, especially, as people get older or have more health issues. The cost of insurance is going up on all policies, but it may get to the point where temporary term policy is all that is available. So life insurance is no cheaper than it was yesterday, than it was today. Life insurance will not be cheaper for you than it is today and then tomorrow, like whatever that day is. So if you don't have a policy yet, look into it. not selling you anything, but I remember when I was studying for this, I was like, oh my God, I need all these policies. But honestly, people should have them in place. I do feel very passionately about insurance, and that's why I've spent my last 15 years of my life working in it. So, participating versus non-participating policies. Participating policies pay dividends to owners when the insurer performs better than expected. This is issued by mutual companies. Dividend options, cash reduces premiums. They can buy paid up insurance, accumulated interest, buy term insurance. So participating, I like to think they are like mutually participating. And what it is if at the end of the year the company's made a profit, they will pay out dividends to its members. Okay. Non-participating policies do not pay dividends. These are issued by stock companies. They usually have lower fixed premiums because they don't include dividend potential. If they make a profit, they get it. Okay. Policy dividends are considered a return of excess premium and are not taxable. So again, we'll get into that in the taxation sections, but it's basically you're getting your money back, and you had already, they consider that your funds have already been taxed, right? You get your taxes taken out of your check. Quick check, which type of company typically issues participating policies? Stock, mutual, fraternal benefits, or all of the above? And the answer is B, mutual. So mutual, they are mutually participating, and we're going to see dividends. All right, fixed versus variable products, another thing that we'll go over in much more depth in the insurance policies. But so fixed life insurance, it is a guaranteed death benefit and cash value. The insurer bears the investment risk. We'll go over that a little bit. Returns are stable and predictable. Variable life insurance, the death benefit and cash value fluctuate. And honestly, not completely true, right? So the death benefit is guaranteed. The minimum death benefit is guaranteed, right? So let's say you bought a $100,000 life insurance policy at age 35. By the age of 100, when the policy matures, it's going to grow some cash value. But no matter where you die in this policy, if you die here, here, or live beyond it, and they're going to give you your death benefit, you're getting $100,000 death benefit. Well, not you, the beneficiaries, right? So $100,000, $100,000. But fixed life insurance is going to guarantee that, the cash value right here, it accumulates that $100,000 at the end of the policy regardless. That's how these policies are built. But a fixed variable life insurance, it's going to invest the funds conservatively in a more safe kind of S&P 500, and they're also going to guarantee a percentage rate, usually lower, maybe 2 to 4%. They're going to say that your cash value is going to grow, and probably increase by about 2 to 4% each year. Okay. And even if the stock market crashed, this is fixed, it is guaranteed. The insurance company still has to pay a 2 to 4% return, right? Cash value. So the insurer is bearing the investment risk, right? If the stock market tanks, if it goes under, and even though they're losing money, they still need to pay at this guaranteed cash value percentage, this guaranteed growth percentage. So it's usually much lower, more conservative. Variable life insurance, you do need a separate license for. We're going to get into that. But they can kind of play in the market a little bit. And so the rate of return could be much higher. They could make it, oops, I did not mean to do that. So let's say that over here, they made 10% this year, and then the next year, 0, and then the next year, 7%, right? So it can fluctuate. but the policy owner is bearing the investment risk, right? Now, the death benefit's going to still be the same, but that cash value, while they have the higher opportunity for the reward, they also have the higher opportunity for risk, right? With great higher risk comes higher reward. So it's just a matter of where the money is being held and who's bearing the investment risk. Okay, so guaranteed death benefit regardless, but what we're talking about here is the cash value. So in a fixed life insurance, it is a fixed number. It'll be, let's say it was, in this example we did 2%, it's going to be 2% forever for the whole life of the policy. Okay, the variable life insurance one, it's going to fluctuate, and the policy owner is bearing the risk. So a couple things you need to know when it comes to variable life insurance products. Variable life and variable annuities are considered securities. They are regulated at the federal level by the SEC, okay, the Securities and Exchange Commission. They are also monitored, regulated by FINRA. You must also have your securities license. So if they say in order to sell variable products, an insurer or a producer must have their life insurance license, right? Because it's the life insurance policy, plus a securities license. If they say who regulates the variable products, it is the SEC, the Security Exchange Commission. If you have both licenses, then you can sell variable life insurance. And the money in variable life insurance policies is kept in a separate account, right? Because they're playing in the market with this, right? So it has to be kept in a separate account from the regular life insurance. So variable life insurance products, you need to know separate account. SEC, securities license issued by FINRA, in case they ask you that. And policy owner bears the risk. And when you pass your life insurance exam, you cannot sell these yet. You would need to go get your securities license as well. But with your life insurance license, you can sell fixed or indexed universal life. So go into those in more detail in the life policies. But most important things, like I said, securities license, regulated by the SEC, must have a securities license issued through FINRA. Policy owner bears the risk. Practice question: to sell variable life insurance, an agent must be licensed by State Insurance Department only, FINRA only, SEC only, or D, State Insurance Department and hold FINRA securities registration. The answer is D. Don't, when you see words like only, right, those are usually tricks. Nothing is ever like 100% black and white, only, matter of a fact. And even though you see SEC or FINRA, you see FINRA and you're like, yep, they need a FINRA securities registration. That's the one, and you move on, you would be wrong because you also need your life insurance license. So don't let that trip you up. All right, how do they determine premium when coming up with life insurance policies? Why did I say, is it getting more expensive? Why did I say it's no cheaper than it is today? There are some things that go into how they determine what they're going to charge for life insurance, how much this policy is going to cost. They're going to look at mortality, expected death rates based on mortality tables. Okay, higher mortality risk equals higher premiums. Now, obviously, accidents happen, freak things can happen. We never ever know if the tomorrow is guaranteed, right? But they are able to, they have statistics and mortality tables in place based on, all of the deaths within the last X amount of time and how old people were and how long the average, life expectancy is for a woman versus a man, things like that. And that's where they come up with these mortality tables, these rates. Obviously, somebody who is 22 years old is expected to live a lot longer than somebody applying for a policy who's 68 years old, right? This one is going to be much more expensive. Um, Interest. They also take interest into account, right? Expected earnings on invested premiums. Higher assumed interest equals lower premiums needed. And expenses, costs of doing business, commissions, administrative costs, overhead, underwriting costs. All of those things go into determining the premium factors. But the most driving force behind it is mortality. But this is a calculation for premium formula. Mortality plus expenses minus the interest they're going to make equals premium. That's how they come up with the premium for life insurance policies. So practice question. If an insurance company increases its assumed interest rate, what happens to the premiums? And the answer is B. Higher assumed interest earnings means the company needs to collect less in premiums to meet future obligations. So if interest goes up, premiums go down. Okay. Premium concepts. There are a couple different ways to pay premium. So net single premium, a one-time payment that covers mortality costs only, no expense loading. Theoretical concept rarely used in practice. So it is a one-time payment that is made, the policy is completely paid up. I did sell a policy like this once. The woman had come into money from her husband passing away. She paid off some debts, things like that, but wanted something in place for her children. So she came in, she was 45. She wanted a whole life policy that would be good, until age 100. And let's say it was $1,000 a month. Or, you get a discount, which we're going to talk about here. If you paid annually, let's say it was $10,000 annually. But it was like you can pay the whole policy in, for $45,000. I don't remember the exact numbers and I don't remember this. I'm not sure if the math is right. I'm just giving you examples. But she came in, people still do it. Say, here, boom, I want the whole policy done. I want it in place. I don't want to have to think about it again. The policy is good. It is paid up. Okay, so a net single premium is also the same as paid up. Paid up policy, paid in full, one-time premium payment. Gross annual premium is the actual premium charged, including mortality, interest, and expense loading. This is what the policy owners actually pay. So the more often you pay, the more often your mode of premium, the higher the cost because of their fees, administration fees. Okay. So if you ever, when you go in to buy your car insurance, right, and they say it'll be $150 a month, or you can buy it for or $600 for 6 months. They're thinking they don't have to send out a bill every month and collect your payment every month and have somebody put it into the system and update your policy. You're getting some of those discounts to pay it, it's for 6 months instead. Life insurance is usually written on an annual basis. So same thing, like I was using that example here. Let's say it's $1,000 a month, but it may be $10,000 annually. Okay. But if you had paid $1,000 a month for 12 months, it would have been a $12,000 policy. Okay. So because you're paying it annually, they're only doing that bill one time a year, you're getting that discount. So let's say annually, I'm not going to use real numbers or math here other than that one, but $10,000 a month. I mean, $10,000 a year, right? Monthly, it was $1,000 a month, right? So if you did it quarterly, maybe it works out to being, the discount works out where it's $950 a month. I don't know what the math is for 12 divided by 10,000 or 10,000 divided by 12. I guess I'm going to do it right now. So 833. And if it's every 6 months, semi-annually, maybe it's 900 a month, right? So you're getting a discount for them having to process it less often. So the more often, the more frequent your payments, the higher the total annual cost due to administrative fees, right? Because if you're paying it monthly, you're ending up paying up $12,000 a year. But if you'd paid it for the whole year, it would have saved you $2,000. So again, made up numbers, but just giving you an idea, and they do love this test question. All right, producer responsibilities and sales practices. We go over your responsibilities in heavy duty on the regulations videos, so definitely check those out. But you have to be doing everything truthful and honest and not misleading, right? Solicitation standards must be truthful, not misleading, cannot misrepresent policy terms, benefits, dividends, or any material fact. You cannot say this policy is going to make you this much amount in cash value if it's not a truthful statement. You must provide required disclosures. You must give a buyer's guide and policy summary at the time of application for the buyer's guide. Sorry. The buyer's guide is kind of like your brochure. This is the policy that we're looking at selling to, right? If they say, great, we want to fill out that application, you must have given them a buyer's guide at the time of application or before. Okay. And then the policy summary is actually, the one with their name on it, their premiums, their everything. That must be given at the time of policy delivery. Okay. Advertising rules, again, must be clear, truthful, not misleading. Must identify as advertising and include the company name. It must be very clear that this is advertising. Okay. Cost comparison methods, interest adjusted cost method, and surrender cost index help consumers compare policies fairly. So you need to be showing any cost comparison methods that are truthful, and interest that is adjusted. It has to be realistic. You cannot just show them the one rare case that you had where somebody did really well. It's got to be certain averages or certain limits for how much you can present in materials. So there's lots of rules and regulations around this. Policy replacement rules. Again, these are going to be more specific in your regulations videos, but whenever you are replacing a policy, okay, that is you are the customer, the insured is canceling or lapsing or letting a policy lapse to come by yours. That's a replacement. So anytime a policy that they have in place is going to no longer exist because they're buying this one, right? So if it's lapsed, surrendered, converted, or reduced in value, it's considered a policy replacement. Common exam trap. Policy replacement occurs when a new policy is purchased and an existing policy is lapsed, surrendered, converted, or reduced in value. Okay? You must provide replacement notices. You must also submit a notice to their previous insurance company. And there's going to be, depending on what state you're in, a certain amount of days until you can, that you have to send that out within. Like maybe you have 5 days, you have to send out that replacement notice. So check your state specifics. Check if our videos are out for your state yet. If they are not, we are rolling those out each week. Comment what state you are in. That'll help us decide which ones to roll out next. We will get you taken care of. And they must submit a notice to the replacing insurer and list all existing life insurances on the application. This prevents improper twisting, which we do have a general insurance regulation video, which we talk about all of the unfair trade practices. And twisting is when you're twisting a policy, twisting the terms, twisting your language to try to get them to come buy your policy when it is not, in fact, putting them in a better scenario. You can replace policies. People cancel policies and buy new policies all the time, right? That's how we stay in business. But it has to be within their best interest. Test scenario. Agent Mike is meeting with a client who mentions she has an existing policy. Mike recommends a new policy that would better fit her needs. When must Mike provide the replacement notice? At the time of application or proposal, not after the time that the sale is complete. This is a heavily tested requirement. All right, application and policy delivery procedures. Okay, when you are gathering the information or talking to customers um, about buying a policy and filling out the application and asking them questions, all of that, that is called field underwriting. Life insurance used to happen a lot in person. It was very personal. Insurance agents would go to your house, sit in your family room, meet your family as they're talking to you about this, you know, um, kind of a heavy conversation, right? And talking about all your finances and all these things, right? And there still are a lot of agents that do things in person, but we also do a ton of things digitally these days, over the phone, over the computer. But it is called field underwriting. You are out there in the field gathering this information. It is the producer's initial assessment of the applicant's insurability. They must complete the application accurately and thoroughly. If you show up and they're smoking cigarettes and, not, they're attached to an oxygen tank and they just don't look like they're in the best of health, but they told you they don't smoke and this, like, you're the eyes and ears when you're out there, right? So you have a responsibility when you're doing the field underwriting. And then when you're filling out the application, there are 2 parts to the application, okay? Part 1 is the general information, and part 2 is the medical information. Know those. Pause this right now and make a note card, make a flashlight or a flashcard. Highlight it, okay? I love this test question. What does part 1 on a life insurance policy consist of? It is general information. Okay, so part 1 is general info. What does that mean? Name, address, um, age, um, lifestyle, and questions like that. Do you go skydiving? Have you left the country? What are your assets? What are your needs? All of that general information. Part 2 is the medical information. What are your medications? Have you had any surgeries? Do you have any diagnoses? Things like that. So part 1, general information. Part 2, medical information. Just know that, okay? Then the next step is collecting the premium. If the premium is paid with the application, you must provide a conditional receipt. Coverage may begin immediately if conditions are met. Now, that's going to vary based on what type of policy you have. I'm going to erase this part 1 and part 2, so make sure you got that. But There are certain policies that are like immediate issue, final expense policies. If you ever get those things in the mail that's like, send in your check and you'll get $20,000 life insurance policy. Those are immediate issue, direct mail. Um, Majority of life insurance policies are going to have underwriting or a medical underwriting, whether or not they actually send somebody out to take your blood and urine or send you for a physical, or they're going to look up your prescriptions and things like that. There is some type of underwriting. But let's say that somebody bought this policy on June 1st, right? They filled out the application and they paid the premium. They paid that first month premium. And it's going through underwriting and it gets approved on July 17th. Okay. If that premium was paid, which is why you must give a conditional receipt saying this policy is immediately, will begin immediately, not really, right? It hasn't actually gone through those conditions yet. You haven't met your medical, it hasn't been approved by underwriting yet. But if it does get approved by underwriting and you did provide that conditional receipt, they're going to say that, okay, that policy began on June 1st. You were accepted, everything. Some people will go, well, no, I don't want to pay that until I know I'm improved, right? Why would I want it to backdate? If it didn't start till July 17th, that's a month and a half later. I don't want to pay till then. Cool. However, if that person dies right here and they did not pay their first month premium, nothing will happen. The policy will not be issued. Nothing will go to the death benefit will not be paid to the beneficiary. If the person dies right here and they did pay that initial premium, underwriting is still going to continue underwriting it. And if the policy would have been issued, it will still pay out the death benefit. Okay. So I always recommend paying paying your first month's premium and getting your conditional receipt. Okay. Because can you just even imagine, right? All right. So if the premium was not paid, and then it gets issued on the July 17th, the policy goes into force here. Okay. So long as nothing happened and the person did not, pass away in time, that's fine. But at policy delivery, they must then collect the premium. You must get that money. It needs to be paid then, at least that first month premium. Okay, sometimes underwriting can take several months if they have to come back, ask more questions, send you for a different exam. It can take a while. I actually had one of my old bosses had traveled out of the country, and so he was prescribed like a unique medication that was to prevent him from getting ill over in this country. But it is the same medication that they give for tuberculosis. And so they were like, we can't issue this policy. This person has tuberculosis. But then once we explained and got a note from the doctor on why it was given to him, it was to prevent in case anything happened to this country, blah, blah, blah. But it took like 5 months to get this policy issued. Now imagine, if something had happened during that time and they had not paid that first month's premium, nothing would have paid out. So sometimes policies can be issued right away. Sometimes they take a little while, and sometimes they could take a long while. So, all right. Once the agent comes back to deliver the policy, if it's been a while, they may require a statement of good health. Okay. Along with the premium if it has not been paid. So, all right, cool. Policy's good, but you need to sign this paper that you're still in good health. All right. Individual underwriting information sources. The number one primary source of underwriting is found in the application. That is why there are a lot of, term policies and things like that that can be issued just on the application alone. Okay, so if they ask you what is the number one source in underwriting? Application. I always thought, God, it should be the MIB, right? That's their actual medical background, but it's no, it's the application. Okay. Then there's also the producer's report. Remember in that scenario, I said you go over the person smoking and attached to oxygen. They're not in the same health that you thought they were. Obviously, the producer is going to be filling out the application with their truthful statements. But if if the other person had filled it out or this, or if there's anything you want to explain, the agent is going to put it in a producer report. This is private between the agent and the insurance company. So it could be, hey, this person was smoking and is attached to an oxygen tank while out. But it could also be, hey, this person went out of the country and took an antibiotic to prevent anything from happening. They do not have tuberculosis. Should he have known that, right? It was just kind of one of those rare things that stood out. Now, I bet if that ever happens again, he's going to know to put that in the agent report. But it's your part where you can put in information to the insurance company with it. They may ask for an APS, an attending physician statement, medical records from the applicant's personal physician, actually filling out, yes, this person's in good health. Yes, I gave him this medicine. Yes, I did this. That may be required. Attending physician statement. They could require medical exams and lab tests. There's a lot of companies out there that will just send, like a nurse or a medical assistant to your house. They'll schedule it and, they'll take your weight and draw your blood right there at your kitchen counter and give you a cup to get a urine sample and boom, go send it off to the lab. And then there are consumer investigative reports. Okay. The insurance company is allowed to interview your neighbors, associates, friends, people you work with about your lifestyle, character, or reputation. This is not as common. This is going to usually be with like very high value policies or maybe somebody that just like has no information on them, like they haven't been to the doctor in 20 years, can't find anything out about this guy. Is this person real? They can do a consumer investigative report. And the person has the right to request their consumer investigative report. So just so you know, if you ever get asked about talking about one of your neighbors, the person will get a copy of this. They have the right to ask for it. And then the MIB, Medical Information Bureau. They love this test question. They will just ask you, what is the database of medical information shared among member insurers? The Medical Information Bureau. Or what is the purpose of the Medical Information Bureau? To share medical information among other insurers. It helps detect fraud and omissions. Every time you go to the doctor, every time you get a prescription, it is put into the MIB. Risk classification categories, okay? There are preferred, standard, and substandard. Now, if you're already working somewhere and you're like, wait, we have way more than that. Yes, depending on what company you work for, what policies you're talking about, they may have like preferred plus, preferred super plus, standard smoker, standard non-smoker, substandard smoker, standard diabetes, right? Fine. But for the testing purposes, it's these three: preferred, standard, or substandard. Okay. Preferred is your best risk, excellent health, no risky habits, lowest premium. Standard is average, right? Preferred is going to be like your athletes, right? Your very, very, very healthy athletes, people that run marathons, things like that. Incredible blood work and never eat sugar, right? So preferred is harder to qualify for. Standard is average. These dollar amounts are not real, right? Because I don't mean that it's only going to be $5 if you're preferred or, in the double digits for this. It's just for a representation. Depends on what policy you're getting, for how long, for how much, whatnot. Policies can be $10 a month. Policies can be thousands and thousands of dollars a month. But this is going to be your normal health, typical lifestyle. Even if you think somebody is preferred, most agencies are going to tell you to write them as standard, submit it as standard, because you'd rather the insurance company come back and you get to tell your client, like, oh my, you know what? Remember how we thought it was going to be $100 a month? You're in such great health. It's only $85 a month. Like, you want to come back with good news, right? You don't want to be, um, okay, the policy is going to be $85 a month because you're in such good health, and then be calling them back and be like, sorry, actually, it's going to be $100 a month, right? You don't want to be delivering bad news. So, usually kind of a rule of thumb, but that's all going to depend on where you work. Substandard, if somebody has some health issues, maybe they have a hazardous occupation, maybe they smoke, maybe they used to smoke, maybe they're diabetic, maybe they had, surgery that, could be something that could reoccur. So this is going to be your higher one. They do like to ask you, what is what is it called for average risk, health, normal health, standard or substandard, preferred. Like, they want you to know the definition, but they could also give you like a scenario of which one's going to cost the most, which one's going to cost the least. Preferred is going to cost the least. Substandard is going to cost the most. There is also another rating class, and that is, not insurable or declined. Classification directly affects premium amount. Better classification equals lower premium, right? The healthier you are, the longer your chance of, your mortality rate is extended, things like that, right? So a 45-year-old applicant is overweight, has controlled diabetes, and works at a desk job. Which risk classification is most likely? And it's going to be C, substandard. The controlled health condition increased risk above standard, but not necessarily result in declination. So they're not going to necessarily, again, this is going to be right here. They said which one is most likely, right? It's going to depend on which company, right? You don't have to be sitting there and underwriting things for your insurance exam. These are done in the underwriting department and underwriting specialists. If that's the field that you go into, awesome, but it's just wanting you to understand the concepts. All right. Selection criteria and anti-discrimination. We cannot discriminate when it comes to life insurance. Cannot discriminate. We shouldn't discriminate anywhere anyway. But insurance is discriminatory by nature, almost, in the fact that they can rate people differently. They can rate men and women differently, but they have statistics to back that up, right? Women statistically live longer than men. Health history, they can, just not discriminate, but the ratings are affected by things like, sex, health history, occupation. And, it can be a little judgy, but it's because they've got the science to back it up. But you cannot discriminate based on things that do not affect your mortality. Okay? Race, religion, national origin, or other protected classes. Genetic testing. Federal law generally restricts use of genetic information in underwriting. And consumer privacy. Insurers must protect personal information and follow disclosure requirements. Okay? All right. So we have made it through life insurance basics. Now, I know there were some areas like life insurance policies that we didn't dive deep into. We are going to have a video put out on that depending on when you are watching this. It's actually the very next video we're putting out that isn't a state regulation video, is life insurance policies in depth and policy provisions. But again, depending on when you're watching this, it may already be out. The taxes, right? We have a video on taxes that we're rolling out. So there are certain things that you may be like, I wanted to learn more about that. But like I said, this is basically FastPass University's chapter 2 when it comes to life insurance, right? Or maybe it's an area you've already gone through it with one of your other policy or with your other study materials, and you just wanted to come back and watch this. But general insurance is what I would consider kind of your chapter 1. Here is your chapter 2, life insurance basics. And then we can deep dive into the others. But you need to know all of these as they all build on each other. So we will take a quiz together. If you need to pause it or mute it, because you don't want to hear me reading it, go for it. And then I will go through the answers afterwards with everybody. And if you haven't yet grabbed your workbook, you can do that. Download it at fastpassinsurance.com. You will have a fill in the blank workbook for this video, and it will have a new set of test questions at the end. So always new questions there. Some of them may be similar, right? Because exam questions can be worded different ways, but you do get a new set of quiz questions with the workbooks. All right, number 1. When must insurable interest exist in a life insurance policy? At the time of application only, at the time of the insured's death, both at application and death, or only when filing a claim. Number 2, which approach to determining life insurance needs calculates the present value of future income? A, needs approach, B, human life value approach, C, capital retention approach, or D, income replacement method. Question number 3. What type of life insurance policy pays dividends to policy owners? A, non-participating policies, B, term life policies, C, participating policies, or D, variable life policies. Number 4, which business use of life insurance funds the purchase of a deceased owner's share of business? A, key person insurance, B, executive bonus plan, C, buy-sell funding, or D, split dollar plan. Number 5, what is the primary difference between ordinary life and industrial life? A, coverage amount, B, premium payment method and frequency, C, cash value accumulation, or D, underwriting requirements. Number 6, variable life insurance products are regulated by which entities? A, state insurance departments only, B, FINRA only, C, SEC and FINRA plus state insurance departments, or D, Federal Insurance Office only. Number 7, what are the 3 main factors used in determining life insurance premiums? Age, gender, and occupation, mortality, interest, and expenses, health, income, and lifestyle, or risk class, policy type, and coverage amount. Number 8, in policy replacement, when must the producer provide a replacement notice? A, within 30 days after policy delivery, B, at the time of application or proposal, C, only if the client asks, or D, after the new policy is issued. Number 9, what is the Medical Information Bureau, MIB? A, a government agency that regulates insurance, B, a database of medical information shared among member insurers, C, a company that performs medical exams, or D, a consumer protection organization. And number 10, which risk classification receives the lowest premiums? Standard, preferred, substandard, or rated? All right, let's see how you did. Answer key. Question number 1 was at the time of application only, insurable interest must exist when the policy is issued, not at the time of death when we are talking about life insurance. Question number 2, human life value approach. This method calculates the present value of the insured's future income stream. Number 3, participating policies. These policies pay dividends when the insurer performs better than expected, typically issued by mutual companies. Number 4 is C, buy-sell funding. Buy-sell agreements use life insurance to fund the purchase of a deceased owner's business interest. Number 5, premium payment method and frequency. Industrial life involves weekly premium collection at the home, while ordinary life uses standard payment schedules. Number 6 is C, SEC and FINRA plus state insurance departments. You need your life insurance license too, okay? Variable products are securities and require registration with SEC and FINRA in addition to the state insurance regulation. Number 7 is mortality, interest, and expenses. These are the 3 primary factors insurers use to calculate premiums. Remember the calculation we did. Number 8 is at the time of application or proposal, replacement notices must be provided when the replacement is proposed, not after the fact. Number 9, a database of medical information shared among member insurers. MIB helps detect fraud and omissions by sharing medical information among member companies. And number 10 is preferred. Preferred risk classification represents the best risk with excellent health and receives the lowest premiums. So hopefully you rocked right through that. If not, go through it again. Check out our other videos. Please make sure to subscribe if you have not. It helps our channel grow and it helps us with the ability to keep rolling out these videos. You can also schedule tutoring on our website or ask questions. We're going to be doing some live classes, so please just subscribe, hang out with us. We are going to be rolling out all the insurance exam content for free, state by state. Okay. Your path to exam success. All right, you've got this. Make sure that you are comfortable with what you should memorize and what you need to understand conceptually. Make sure that you go over the commonly missed topics. Life insurance basics represent a significant portion of your exam. Master these concepts and you're well on your way to passing. Review this material multiple times with your practice exam, sample questions, our workbooks, things like that, and you should be in an excellent spot. So good luck on your fast pass, and we will see you soon.